That's cool. This room works so much better. We got to figure out how we can score this room. Okay. Awesome. All right. So last class, I messed up this problem because there's a typo in the problem. And so I wanted to go back and do this problem again at the end of chapter 9 notes, and then also talk about the multiple product sales mix. So if you need notes for chapter 9, they're up here. And then after that, we're going to do chapter 11. So 11's up here too. So you can come and grab either one of those if you need. So what I want to do is I want to change this problem. So instead of 40,000 shirts, it's 140,000. So if we do that, then our sales will be high enough that it'll be more than the net income or the before tax profit on the problem. All right. So in this particular problem, we are making some shirts and we're going to sell them for $40 each. So there's our sales price, our price there. So this is our price. And then we have our VCU for this shirt is also $20. So sales are 40 for each one. And we're going to times that by 140,000 units to get our sales price, our total sales. So 5.6 million. And then we subtract our variable costs. So in this case, it is $20 for each one times 140,000 units. So we'll subtract that out of it. $2.8 million. Now, because it's set up kind of cool, our contribution margin is also 20. Oops, I don't want that in parentheses. So that makes our contribution margin also 2.8 million. And this is the typical setup for the contribution margin income statement. So we have sales minus variable costs equals our contribution margin instead of sales minus gross profit. I'm sorry, sales minus cost of goods sold equals gross profit. So we'll get the contribution margin instead of our gross profit. And after this, we have to subtract our fixed costs. In the problem, it doesn't give us that. It says, bless you, we plan to sell, it said 40, I changed it to 140 for the year. At this level would generate a before tax profit of 2.5 million. What's the degree of operating leverage? So we don't know what the fixed costs are, but they did tell us that our before tax profit is going to be 2.5 million. So we can just subtract the 2.5 from the 2.8 and find out how much our fixed costs are. So that will be 300,000 or 0.3. And there we've got the income statement. And for most of the problems, you can calculate the whole income statement out. Mostly, not always, but most of the time you can. All right, so questions so far on that? We're good. All right, degree of operating leverage is the ratio or the relationship between our contribution margin and our profit. Sometimes this is called operating income instead of net income. Sometimes it's called before tax profit, like here, before tax profit. No matter what they call it in this chapter, in this class, it's talking about that number at the bottom of the income statement. When you're in intermediate accounting, then those words have different meanings, whether it's before tax or after tax or net income or operating income. Those are different places on the income statement. In this class, they're using them all interchangeably, which is arguably confusing. I agree. But that's the number that they're talking about when they ask for that. So it's the ratio between these two. So the closer these two are together, so this is 2.5 and that's 2.8, those are pretty close together. The smaller our net income, our fixed costs are. So we have a really small fixed cost in this case. So when we do that ratio, the degree of operating leverage, we are going to take the 2.8 million and divide it by the 2.5. And I think it's like 1.12. Yeah. So our degree of operating leverage is 1.12. It needs to be more than 1. One is the lowest number it can be. Smaller equals lower fixed costs, and larger equals higher fixed costs. And this matters because it's showing us the relationship between our contribution margin, our fixed costs, and our net income. Back on page, nope, not that one. Here, do you need chapter 11 or chapter 9? You got it? Okay, good. There's 11. So in chapter 9, back on page 5, there's this chart here with these two levels of fixed costs. So in one chart, they're showing the fixed costs up here really high, related to the sales, and the other one is showing it down here really low relating to the sales. And they're trying to make the point that those two graphs have the same break-even point. Maybe they do, but the difference here is that the fixed costs and the variable costs are on a little bit of a teeter-totter. That's the concept they're trying to illustrate. Let's say that you had a laundry business. If you are going to wash all the laundry by hand, hey, here's chapter 9 and chapter 11. If you're going to wash all the laundry by hand, you're going to have a lot of variable costs because all your costs are going to be labor, direct labor for the people who are like swishing the clothes around in the wash buckets or whatever you use. And the fixed costs are going to be very, very low. You don't have to spend very much money to get started if you're going to do everything by hand. But the variable costs will be very, very high. So even if you have a lot of production, those variable costs are going to follow your production. They're going to be there the whole entire way. So you could increase production a lot, and it might not increase your profits very much because those variable costs are always going to be there with every new unit of production. As opposed to you buying a laundromat. You buy a laundromat, it's a huge outlay of cash at the very beginning. Huge level of fixed costs that you have to overcome. But once you do that, your variable costs are so much lower. So you can pick high fixed costs or high variable costs. The cool thing about fixed costs is they don't follow you with every new unit of production. Once you overcome your break-even point, your profit margin grows really fast because those variable costs are low and they stay, well, not in this example, but if you had high fixed costs, those variable costs would be low and you could grow your profits so much more quickly after you overcome that hurdle or that threshold of recovering your fixed costs. Because the more laundry you do in your laundromat, the more money you're going to make because you don't have to keep buying new laundry machines. So until they're in use all day, every day, you're going to be able to make a lot more profit than if you have to pay someone to wash the laundry every single time you get new laundry. You have to find a new worker to do more work. Hi, here's 9 and 11. So they're trying to illustrate the difference between high fixed costs and high variable costs. So if you want to have a low-cost leadership strategy, then you're going to want to try to have as much fixed costs as possible. Low-cost leadership requires low variable costs. So Walmart is only able to sell at low prices because they have a humongous, very, very expensive distribution system. They've outlaid billions of dollars to build stores and distribution channels and systems so that they can reap the rewards of those very, very low variable costs because they are able to invest so much money into the fixed costs. This is one of the benefits of capitalism. In capitalism, you're able to acquire these huge amounts of capital that allow you to overcome those fixed costs to then make more products available at lower prices to more people. It's a benefit, absolutely. If Walmart wasn't able to be a corporation and raise capital through stock market, like crowdsourcing their capital, they wouldn't be able to pay those high fixed costs and then keep their variable costs low to provide products to us at a lower price than their competitors could. So if you don't have money for the fixed costs because you don't have enough production or sales, you have to go with the specialization or differentiation strategy until you're able to overcome those. You get enough capital to overcome those fixed costs. And then your variable costs will go down. And it takes a while. Amazon had losses for decades before they started pulling a profit. And you might see news reports about how Amazon didn't pay any taxes this year. I think they finally did have to start paying taxes recently. But the way the tax code works is if you lose enough money and you don't have any profits to put against it, it just carries forward. If you've had a tax class, you've learned about the net operating loss carry forward. It carries forward for 20 years. So if you have enough losses, you can just keep carrying forward those losses and netting them against your profits for 20 years before you ever have to pay taxes. And that's what Amazon did. Their losses were so colossal in the 2000 to 2008 time period that they had enough loss carried over to zero out their tax liability for almost a decade. But now they're big. And now I'm sure it's run out. We could investigate, but I'm not really actually sure, but I bet it has. All right, anyways, so you have to have a lot of cash and a lot of capital in order to do this high fixed cost, low variable cost strategy. This company here that's making men's clothing, that's a pretty low price, $40, but it's still not a high fixed cost operation. If they had a lot of machinery, their fixed cost should be a lot higher than that. And if I had made this 400,000 instead of 140,000, then the degree of operating leverage would have been a lot higher. So it's just because of how I set up the problem. Questions on that? All right. So now let's talk about sales mix and weighted average CMU and weighted average CMR. All right. So sales mix is the proportion of products that you sell if you sell more than one product. So these companies wouldn't just sell one thing. So we're not going to have just one production level or one price or one contribution margin per unit. We're going to have a number for each product that they sell. So let's say that they sell product A, B, and C. So I'll put that in right down here. I don't know if you guys even have room. Let me look. So I think I'm all off. Well, there's some room on the next page in the back. Okay, so let's see. I'll put this in here. So we have product A, product B, product C. So there's going to be two different percentages that we're going to be looking at. One is the number of units sold. So let's pretend that however many units of A we sell, so if we sell 1 unit of A, we sell twice as many units of B. So if we sell 1 unit of A, then we also sell 2 units of B. That's just how the customers buy it. And for every unit of B we sell twice as many of unit C. So that would be a 4. All right, so the total number of units we sell them in groups of 7. That's just how it works out. 1 plus 2 plus 4 is 7. And this is what we call a combination unit, a composite unit. I think some of the books call it a composite unit. I call it the omni unit because it's kind of like the unit that rules them all. It encompasses all the units. But what we're going to concoct an omni unit or a composite unit that is actually 7 individual items, kind of like a combo meal or a bundle, right? So we're going to now pretend that this group of 7 units is one bundle. And then what we're going to do is we're going to assign that bundle a price, a variable cost per unit, and a CMU. And we're going to have to do it in these proportions here. So first, we have to calculate the proportions. So this one is 1 out of 7. This one is 2 out of 7. And this one's 4 out of 7, which would give us 7 out of 7. So that's the proportion. And then I have to do a little bit of math. Oops. 1 divided by 7 is 14%. 2 divided by 7 is going to be 28%. And then they have to add up to 100. Yeah, my 1 omni unit. So I'll do 100 minus 28 minus 14, so 58. So this is 58%. So the omni unit is 7 individual units. 58% of the omni unit is made of C. 28 is made of B, and 14 is made of A. So that is the number of units. We're going to have another weight that's based on sales dollars. So this is the units percents. Then we're also going to have dollars sold, because they might have different prices, right? They might not all be the same price. Like if all these were $1 each, then the sales would be in the same percentages, but they might not be in the same percentages. So let's put in a price. Actually, I'm going to put in a price here. So this one is $1, but this one is $2, and this one is $3. So if we have 1 unit of A and it costs $1, then the sales of that individual unit is $1. If we have 2 units of B and they cost $2 each, then those sales for B are equal to $4. And then for C, we have 4 units. We sell them for $3 each. So the sales for unit C would be $12. So the total of all the sales is $17. 5 plus 12, yeah. So now we've got new proportions. So this one's 1 out of 17. This one's 4 out of 17, and that's 12 out of 17. So that's 17 out of 17. And then we'll have new percents. And you know, this is actually what we call the weight. That's how much it weighs. Because we have, and it's a weight because it's all glommed together in my omni unit. So that's how much A weighs in the Omni unit. It weighs 14% of the units. And then we're going to have weights for the dollar amount as well. So when it comes to sales, the weight of A is a lot less than it is in units. It's only 6 cents of the $17. Oh, sorry, 6%. Sorry, not 6 cents. So it's only 6% of the $17. And then B is 4 divided by 17. So it's 24% of the $17. And then this one, it has to add up to 100%. So I'll minus 24 minus 6. So it's 70%. So if we're just counting number of units, those are our weights in the number of units. But when we look at dollar value for sales, these are our weights. A weighs even less, and B weighs less, and then C weighs a lot more because we're charging $3 for each unit. So it has the most units, but it has way more, a higher weight, higher percentage of the total sales of our Omni unit. So if we're looking at the volume of our Omni unit, it's these percents. But if we're looking at the dollar contribution to sales of our Omni unit, it's these percents here. So these are our weights. This is how much each individual product weighs in our composite Omni unit. It's the only way we can do a cost volume profit analysis when we have more than one product, because every single product is going to have its own price, variable cost, and contribution margin. And so the only way we could do that with multiple products is to make a different graph for every product. But fixed costs go to everything. So if we don't want to allocate those out to each individual product, we want to look at the company as a whole, then we have to combine all of our products to one profit line, one cost line, so that we can evaluate them in the aggregate. So the next part of the notes has all the answers already filled out for you, but I wanted to talk you through it. So here is the setup, and this is, I think it is jackets, if I remember correctly what the example in the book said. So this company makes jackets. They make a jacket called Calm, one called Windy, and one called Gale. And they have two different percentages here. They've got the sales dollar per weights here. So when it comes to sales dollars, Calm makes 50% of the money, Windy makes 40% of the money, and Gale makes 10% of the money. And when it comes to the actual sales volume, number of units, 52% of the units sold are Calm, 39% are Windy, and 8% are Gale. So it's really close to the sales percentages. They're almost the same. It seems almost silly to look at them differently because they're so similar, but these are our two weights. And then here's the individual contribution margin ratios for each product, and the individual prices, variable costs, and contribution margins for each product. So Calm, we make $6 for every unit we sell that goes toward our fixed cost and profit. Windy, we make $8 for every unit towards our fixed cost and profit. And then Gale, we only make $4. So we would hope we'd sell a lot of Windy, because that one's the most profitable for us. It has the lowest variable costs. So we want to sell as much of that as possible. So a lot of your low variable cost items, that's good. You see this in stores. Like selling a lot of fountain soda is great because the variable cost on fountain soda is so low. You sell a soda for $3, it's almost all contribution margin, because there's like the cost of the syrup and the water is almost zero. So you get a whole lot of contribution margin for each soda you sell. But you sell a burger with 3 patties, yikes. The variable costs on that are going to be a lot higher. Your margins are going to be a lot lower on those. So sell as many sodas as you can. That will help with your profits. So in this case, they want to sell as many Wendy's as they can. And then Gail, fine, that's there because we need variety and attract customers, but hopefully they'll switch and buy this one instead because this one we make more money on that one. All right, so we've got 3 contribution margin ratios. So we can't draw one graph or 3 contribution margins, 3 ratios. We can't do one graph that has 3 slopes on the profit line. This is 3 slopes on the sales line, 3 slopes on the cost line, 3 slopes on the profit line. So that would have to be 3 graphs. But we don't want to do that. We want one graph because our fixed costs are 168. So we just want to have the one graph that has fixed costs of 168, and it has to combine all 3 of these units together in that graph. So we're going to weight the numbers and then add the weights up after we multiply it, and that'll give us an omni price, an omni VCU, an omni contribution margin per unit, and an omni ratio. We can do that for all of them. So in this particular problem, the first thing we're going to do, it says, is to calculate the average CMR, but we're going to weight it. So the average isn't going to be even. When you learn to calculate the average in elementary school, they say add up however many numbers there are, or add up all the numbers and divide by how many there are. You're giving each one the same weight when you do that. We're not going to do that. We're going to multiply by the weights and then add at the end. So we'll do the average CMR for all 3 and the average CMU for all 3. And then we're going to calculate the break-even point in dollars and in units, because we're going to use our, what's that? What did they call it? The shortcut ratios from the book, or formulas from the book to calculate the break-even point. Okay, so first one, the weighted average CMR. Where's my thing here? I guess I didn't have to do all that. I'll just pull this one down here. So weighted average CMR. Okay, the CMR is calculated as, we have our sales minus our variable costs equals our contribution margin minus the fixed costs equals the operating income or net income. So the CMR is equal to the contribution margin divided by sales. And then the other ratio we have is the degree of operating leverage, which is the contribution margin divided by net income. So for the CMR, we just do contribution margin divided by sales. Oops. And for the degree of operating leverage, it's contribution margin divided by net income. And these 2 numbers, sales and net income, they're the same on a regular income statement or contribution margin income statement. It's just the numbers in the middle that are different. In the middle, you have cost of goods sold, gross profit, operating expenses, or period expenses. Here you have variable cost, contribution margin, fixed costs. All right, so the CMR is the contribution margin divided by sales. So because contribution margin is using sales in the calculation, we're going to use the sales weight for that. And then the other number it's asking us to do is the contribution margin per unit. So the CMU is equal to the contribution margin divided by the units. So for this one, we're going to use the unit weight. So for this, we use the, whoops, that's not what I wanted. Okay. Sales weights. And then for the CMU, we're going to use the unit weights. This is really fussy and not strictly critical. Also, it's not GAAP, so you don't have to do this. You can use the same weights for both if you want. Not in the book, but in real life, especially when the weights are so similar in the problem, it's actually would be fine to do that. All right, so I've got my calm and windy and gale here. And it's up in the problem. It's got all of the numbers for me already laid out. So the weights on the sales are 52.63%, 39.47%, and 7.9%. So they've already calculated those out for me, so that's pretty nice. Now I just need to multiply those by the CMR, and that will give me the weighted average. So the CMR for calm, it tells me, and this is given in the problem, is 20%. And the CMR is the contribution margin divided by sales. And for this windy, it's 25. And for gale, it's 10. Oops. I keep doing dollar signs instead of percents. Now, those do not have to add up to 100. They don't have to add up to 100 because those aren't weights. Those are actual measurements from each individual unit. So it's kind of like $10, $8, $7. The prices don't have to add up to anything special. And neither do the variable costs or the contribution margins. Those are the actual numbers for those actual products. It's only the weights that have to add up to 100%. So we're going to make sure that we don't over include any one of these. If we did this average evenly and just like added 20 plus 25 plus 10 and divided by 3, that would be weighting each of the 3 evenly. So if I did CMR of 20 plus 25 plus 10 was 55 divided by 3, I'd get a CMR, an average CMR of 18. That's 20 plus 25 plus 10 divided by 3. So if I don't weight it, I get an average CMR of 18. Not the worst, but it's better to weight it because calm is way more important than gale. So we want to include more of calm than we do of gale because it's more important for sales. So we don't want to weight them evenly. All right. So do the math. 0.5263 times 20%. We get 10.5. And then for windy, 0.3947. Oh yeah, I don't have to do it because I put it in my notes. I already calculated it. This one ends up being 10, and that one's 10, and this one is 1. Then we add those up, and it is 21%. Okay, this is our weighted average CMR for all 3 products. And now we have one CMR, and oops, we can do calculations as if the combination of those 3 units, this sales mix, has a CMR of 21%, which kind of makes sense because it's, oh wait, yeah, because 20, 25, 10 is about 21. Yeah. I did? Oh, yes, I did. Oh, thank you. So sorry. I used the unit percentages. Sorry. The totals are right because I'm like, wait, that doesn't seem quite right. Sorry. Thank you. All right. Extra credit for everybody. 40 and 10. All right. You're right. I did. There we go. So those are the weights. They still add up to 100. 50% times 20 is 10. There and there. Yeah. 10% of 10 is 1. Good job. Thank you. That's my average CMR for everybody. Now I'll do the average CMU. And I know it's on the next page in the notes, but I'm going to do it here. So I've got the percent in units weight. And those are the percents I had up there before. That's the 52.63. And the 39.47 and 7.90. They have to add up to 100 because those are the weights. Since CMU is divided by units, we're going to use the unit weights. CMR is divided by sales, so we use the sales weights. That's how the book teaches it. You don't have to do that in real life if you don't want to. You can weight it however you want. This is a giant estimate. All of this is an estimate. It's all going to be wrong. It's okay. We can still use it to make predictions and forecasts, but we're not calculating what's actually going to happen because we don't really know. We can just say, this is usually how the sales percents shake out. This is usually how the unit sales shake out. They might not this year. We might sell a lot more Gale. Maybe there's like a lot of wind this year and people buy a lot of Gale jackets. And so there's no calm jackets bought this year because the weather changed. Well, we didn't foresee that. So all our calculations are booty, and too bad for us, we messed it up. So if the book says use these weights for these calculations, which makes logical sense, it's fine. But because it's an estimate, it's not necessarily right or wrong to use sales weights for both or unit weights for both, especially in this situation where they're so similar. 50 to 52, 40 to 39, 10 to 8. They're almost the same anyway. If they were very, very different, I could see caring more about which weights you use. In this particular case, I think it would be okay to use the same weights for both because they're so similar anyway. All right. So we're going to multiply that by our CMUs. And it gives us that in the problem as well. 6 and 8 and 4. Those don't have to add up to 100 because that's just the actual dollar amounts that they are. And this gives us our weighted average CMU. And I already did this math for you as well. So for calm, it's $3.16 or 15.78. $3.1576. When you do your homework, if you haven't done it already, just double check that double check how it says to round it. So you get the rounding right. Okay. So now I have a weighted average CMU. This is the slope for my profit line that has all three products in it. So now I can say, oh, now I can see what my slope of my profit line is going to be to do my calculation. So in fact, I can go to, and I could do it for all of them. I could do it for the sales. I could do it for the VCU. I would use the sales percents for the price. I'd do the units percent for the VCU, and I could get all the lines. I could do all the graphs with all three products. So let me go here to so if I'm doing the profit line, it's going to cross the x-axis at the break-even point. So my slope is 6.63x, and then the fixed costs, it said, are 168,000. There it is. Oh. Minus 168,000. There we go. All right. So that's our profit line there. Let me adjust it just a little so it y-axis goes up a little higher. There we go. That's my break-even point right there. Zero profit is that many units, 25,339 units. Is that what it says in the book, in the notes? For break-even point in units? 25,334. Nice. So on page 9, BEP in units, 25,334. Problem though, this is all the units. So we don't have it split out into A, B, and C units, product or gale, windy, calm. This is just 25,000 with all the units combined together because we're using our Omni unit with the weights to do the slope. All right, this is the slope of the profit line. So now we've got our two shortcut formulas from the book. One is break-even point in dollars is equal to fixed cost divided by CMR. The other is break-even point in units is fixed cost divided by CMU. Yeah. Because we're doing a sales mix, we have to use our average CMR and average CMU to get those numbers. So for the dollars, it's 168,000 as our fixed cost divided by 0.21 or 21%. And I already got the answer. That is 800,000. Now that 800,000 includes 50% of that is for calm, 40% of that is for windy, and 10% of that is for gale. Because that's our sales mix. So this is 50% calm, 40% windy, and 10% gale is what makes up that 800,000 there. And that's because those are the weights for the sales. So 400,000 of that is from calm, 300,000, I don't know, 350 or whatever, 320 is for windy, and 80 is for gale. So that's like all of them added together. All right, so now for the next one, it's fixed cost, 168,000 divided by CMU, which is $6.63. And we get that number 225 or 25,334 units. And that is 52.63% calm and 39.47% windy and 7.90% gale. And when I did the graph, it said 25,339. So that's probably a better number than 25,334. And then you see in the notes how I broke those out. So that the calm is 13,000 units and windy is 10,000 and gale is 2,000. When you get that 10,000 number, you know you did it right. That's like, oh, yay, I got the answer because it's 10,000. Unfortunately, that doesn't often happen on the test because I usually just kind of like pick numbers and then try it out. Sometimes I'll work backwards so that you get a nice number so you know you did it right, but not always. But in this case, it was nice. The first one, not so much. 13,334 is pretty annoying, but 10 and 2, those are good numbers. That feels nice. So this is how we're going to actually be doing this cost analysis. We're going to actually be combining all of our product line together into one contribution margin ratio, so we can make one graph for everything. We can do the individual graphs as well, but if we do, we'll have to allocate those fixed costs to the products, which luckily you guys know all about allocating fixed cost to products. You know about cost drivers, you know about picking the cost driver, measuring the driver, calculating the allocation rate, and allocating on the driver. That was in chapter 7 or 6 or something. So you can make individual graphs for each product, but like I said, you'll have to allocate that 168. Pick a driver, maybe units, that's fine. Gap would be happy with that. Allocate it based on the unit weights and then do an individual graph for each product. You could do that. That would be fine. You guys have questions? Or 17. Okay, good. We are farming like a pro. When I was a kid, we had this game called the farming game. It was a board game. And I can't remember, there was another little part of that, something, farming like a pro. And the game was really sad because you'd like plant your farm. And we had these little vinyl, like little stickers, and you'd plant like grain and grow apples, and you'd have cows. Most of the squares on the board, it was kind of a year that you went around a calendar. Most of the squares, you just like had to like destroy your crops and kill your cows because they like would get sick or catch a fire or there was a drought or something. It was the saddest game ever. But there was one square that said, oh, that's right. It said right on time and farming like a pro. It was like everybody's favorite, because we were little. It was our favorite space to land on because we didn't have to like destroy any of our farm. It just kind of turned into like a family joke about being right on time and farming like a pro. All right. We're skipping chapter 10. Chapter 10 is about budgeting, which is not unimportant. That's a dumb way to say that, which is important. And I want to cover it, but the way that it's presented in the book and in every book ends up being me saying, put this number here, 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 there. You did it. Isn't that great? And you going, I guess. It's never as educational as it should be. And I'm working on that. Basically, what budgeting is taking these cost predictions and creating a forward-looking income statement. So I say, what will the income statement be? Okay, so how much do we need to produce? Okay, so how much do we need to order? Okay, so how much money do we need to order that? And then you kind of just like work backward in time. So we're going to skip chapter 10 because I know you guys know how to make an income statement, and I know you know how to do costs. And this chapter is way better. And it's not as like convoluted, and this one's way more applicable than the budgeting chapter because budgets are very industry company specific. So we're going to jump to this chapter. It's about decision making. And chapter 11 is one of my very favoriteest chapters ever. I love it to death. And I hope that you get some good information out of it. The first part here is something the book does that kind of makes me a little bit annoyed. And that is that it seems like it just gives you like really, do you need an 11? Anyone else need an 11 handout? No, okay. It gives you information that seems really obvious. Like they felt like maybe they needed to write something. So they're like, just write some obvious stuff that everybody already knows. So that's kind of what I feel about this. I changed it a little bit. So if you go look in the 5-step decision making in the book, it's a little bit different than mine that I put here, but I tried to make it more informative and useful to you instead of like, think about your choice options, pick one. Like, no kidding, we've been alive before. We've made a decision before. We're not aliens. So this is how I've redone it a little. So first, decide what your strategy is. Are you going to be a low-cost leader, or are you working in a, oh my gosh, my mind just went blank. What's the other one? Differentiation, right? So most of the time you're going to be differentiation unless you're giant. And that's going to come with its own set of fixed and variable cost relationships. So if you're a low-cost leader, you probably have higher fixed costs and lower variable costs compared to a differentiation where you probably have higher variable costs and lower fixed costs. So figure out which one you are and then find all the different choices you have available. So in this chapter, we're going to be talking about, should we make our product or should we buy it from an outside supplier? Should we keep making this product to sell, or should we discontinue it because it's not popular enough anymore and it's losing money? Should we invest in this new piece of machinery or keep the old one and keep using the old one, even though it's less efficient? So those are the kinds of decisions we're going to be making in this chapter. Then look at all the costs and identify and collect the relevant information on a short-term focus. So this chapter is specifically short-term, specifically financial. When you're making real decisions in real life, you have to and you should think about things that aren't related to money. This chapter pretends that those things don't exist. There's no morality, there's no humanity. The planet has infinite resources and governments don't interfere. In reality, we know that none of that is true, but in this chapter, that's how they frame things. When I was in my undergrad and I took this class, this chapter really caught my imagination. I got so excited about thinking about the whole entire world in terms of money. And it kind of messed me up just a little bit for a little while, because I'm like, no, if I don't eat, then I will save money. And I gave myself little teeny baby eating disorders and not serious, but for a minute I was really not okay. And just I started making weird decisions when I was out with my friends, and I was everything. I'm like, it's just because of how I am, but I just got so excited about solving the world through the magic of math. And that I doubt any of you are that neurotic. But if you feel yourself thinking, if I only think about money, everything becomes so much clearer, that's because you're on your way to being a supervillain and you will be destroyed by the Avengers. Anyways, don't do that. So we're in this chapter, though, we're only focusing on money. So when it asks you, which should you do? It wants you to pick the cheapest one. Always. That's what it wants. Pick the one that's cheapest. Whatever's cheapest, that's the one you pick. Doesn't mean it's the right choice. Doesn't mean the ones you would really pick in real life. When it's asking what should you do, what's the best option, what it means is what's the cheapest option. That's what it's asking. And then only look at relevant information, which we'll talk about in a minute. Select the best course of action and then let time pass. I added this. And then after time passes, evaluate your decision. So often, especially in working in education and for the government, educational administrators and government officials are almost always beholden or elected to their position that they have. And the way you get elected is by showing that you make great decisions and implement great plans. So as a politician or an educational administrator, you'd say, we're going to implement this new software, this new teaching thing, this new tool. Okay, everybody, implement it. Okay, did it work? And we're like, oh my gosh, we don't even know how to use it yet. And they're like, well, tell us if it worked. Tell us if it worked. And we're like, no, actually, not really. The projector was broken and we had to go to this, and the students didn't really understand. I still don't really understand. We're still trying to get it. And they're like, oh, another failure. Okay, let's try this then. And they start a new thing before we ever even get off the ground on the first thing. So I put this in because that happens in corporate world too. They want to make, people who make high level decisions often are very impatient. It's part of why they get to the place that they're at. And they say, I made a decision. Okay, how'd it go? And genuinely, we need some time. It might take a couple years. You got to let time pass and then evaluate. And you're not going to know immediately if you made the right choice or not. Years ago, I had a student and I was doing advising. He was assigned to me as his advisor and he was fine. He was like a B level student, and seemed okay, but he was almost ready to graduate. And he was graduating in December. And he came to my office and he was like, I have to drop out. I need you to drop me out. And I was like, oh my gosh, graduation, like the end of the semester is in like 2 weeks. You're graduating in 2 weeks. And he's like, well, I'm not going to take my audit final. And I wasn't teaching audit, I was teaching AIS. And he's like, I'm not going to take my audit finals because I can't pass it. I don't want to study. I'm burned out. I hate accounting. I don't want to be an accountant. I never want to do this ever again. I just want to be a bartender. And I'm like, oh, yeah, same. But problem, no. We don't do that. And he's like, well, I'm going to. I was like, okay. All right, look, fine. You're looking purely at the non-financial aspect of this. And me, as your advisor, I'm going to counterpoint financial aspect of this. He's like, I'll make more money as a bartender than an accountant because I'll be a terrible accountant. I was like, also probably true. But it's not just money. There's other things involved. I had to really come up with like a lot of reasons. I finally convinced him. I called his audit teacher. I'm like, please just give him like a 60 on the final. He needs a 60. And she's like, of course. I mean, we're not going to like fail people who get a 50 on their final so they have to stay another semester for one audit class. She's like, yeah, of course. I don't know how it works here, but that was how it worked there. We're not going to fail somebody that's like 10% away from graduating. So I go back. I'm like, just take your final. Here's some study materials. I talked to your teacher. She's really nice. No, she's the worst. She's so mean. Like, she's fine. She's fine. She just has little kids. It'll be okay. And go take your final. He did. He graduated, and he's in Ocean City earning tons of money as a bartender. Fine. I'm really proud of him. I'm glad he's doing that. I was there, and I saw him, and he was like, told you. I'm like, I didn't say don't do it. I said graduate. and it was, and you know what? Fine. Here's the thing, the reason I tell this story. We don't know how to evaluate the decision-making process. We didn't know how in the moment. He had his decision-making criteria. I had some different decision-making criteria. My job was to convince him to graduate. So I did that. I didn't put a lot of my own feelings into it. I just was like, okay, counterpoint to your decision because I feel like the whole entire world is going to be against you on this decision. Let me just put that voice forward in a rational way and then convince you to do it anyway. So I convinced him to do something he didn't want to do. Was that the right choice? I don't know. Maybe it would have made absolutely no difference in his life. Other than that, he felt pressured into do something he didn't want to do. Maybe it gave him a sense of accomplishment that helped. We actually won't know for a while. And so sometimes you can't evaluate until you wait, until time passes. So when you're trying something new or implementing something new, give it time. Try not to be too impatient and just accept the fact that you're not going to know what would have happened if you'd made the other choice. That's the most frustrating thing for me and a lot of people that are analytical is that I want to know the future so I can pick whichever I want to be. Like efficiency and optimization is like the best. Doesn't always work. All right. One really important word here is this word relevant. Right here. Okay. That word has a lot of meaning in your everyday life. If it means important, like if English isn't your first language, you're not 100% sure, it means that it matters and it's important. in this chapter, that's not what it means. We're going to give it a very specific special definition so that you don't get confused and start trying to like bring in all these like other options that aren't part of the question. All righty. Oh, that's just a diagram of that list up there. Relevant costs. Okay, they have to be in the future. So it has to be money that we're going to spend in the future. If we already spent the money, then it's not relevant to decisions in the future. And that's because the relevant costs have to differ between the alternatives. If we already spent the money, then it's the same for both alternatives. Let's say I have purchased a like a protein bar, and it's in my bag. And I go to lunch and I'm trying to decide if I should order a chicken sandwich or a hamburger. The money I paid for the protein bar doesn't affect my decision of whether to buy a chicken sandwich or a hamburger. It just doesn't. Because if I buy the hamburger, I still spent the money on the protein bar. If I buy the chicken sandwich, I still spent the money on the protein bar. I spent the money with either choice of that. Now, what if the choice is eat a protein bar or eat a hamburger? Okay, the money I spent on the protein bar still doesn't matter because I already bought the protein bar. If I eat the protein bar, I don't have to spend money on a hamburger. If I eat the hamburger, I do have to spend money on the hamburger. So now the thing that's different is the price of the hamburger. The money I spent on the protein bar is the same no matter what. So that's the first thing we need to grapple with in this chapter is that costs in the past are the same with whatever option we choose in the future because they already happened. So we're not going to use them in our evaluation. If you do, you'll still get the same answer for a lot of the questions in terms of yes, accept, or no, don't, because you'll just have that same cost on every option. It just makes the analysis more complicated. Okay. Alrighty. So in this chapter, we're only considering relevant costs. Future costs and costs that differ between the two different options. So the book will say, here's two choices. Buy a new machine or keep the old machine. Those are your two choices. Now in real life, obviously there's going to be more than two choices in decisions, but let's say you've narrowed it down to two. And now it's time for the financial analysis of these two choices. So you're only going to look at costs that are going to happen in the future, and you're only going to look at costs that are different between the two choices. All right, sunk costs. Sunk costs happened in the past. The room will shut down in 10 minutes. Keep using room. Sunk costs are not relevant because they already happened in the past. That's what a sunk cost is. It's a cost that already happened in the past. So I put a not relevant. You already spent it. So don't put it in your analysis. It doesn't mean it doesn't matter. It doesn't mean that in your everyday life you don't need to think about it. But in this chapter, you don't put it in your analysis because it already happened. This sunk cost is, it's one of the like fallacies. Like if you've ever seen like lists of logical fallacies, sometimes they're in social media or people will talk about them. There's a sunk cost fallacy. And that is that, well, I've already put so much into it, so I don't want to give up now. That's a fallacy sometimes, but not always. Okay? If something can change and it just needs a lot of effort to make that happen, sunk cost that's not a sunk cost. Training a dog, right? I have a couple of dogs, and I work really hard to train them. And they get better every single day that I work with them. They get better and better. Even though one's kind of old, he's like 14, he's still getting better. And the other's a puppy, and he's getting better fast because he's a puppy. If I tried to train the dog for like a week and they still hadn't learned what I wanted, and I'm like, well, what should I do? Keep the dog or throw the dog away? Ugh, I already put so much training into him, but that's irrelevant. Throw them away. Like that, when you're dealing with humans, where an investment grows and builds, when you're dealing with life and living things, sunk cost is not, it is important, okay? When you're dealing with money, sunk cost, not important. This is just money. Don't go all wild with the, well, you were rude to me, so I don't care how much time, effort, and time we put into this relationship. You cheated on me, so we're done. You can still say that if you want. But like, flip side, you put a lot of time and effort into the relationship and they still cheated on you. So maybe, yeah, kick them to the curb. I don't know. I just don't want you guys to start thinking black and white when you're interacting with people in your relationships, because we're doing it on this chapter with money, because that's what I did. And I got all like pathological about it. Like I said, it was a long time ago and I got over it, but it's just money. Though you can actualize this. We did make a family rule at our house, and it was related to the sunk cost fallacy. And that is, just because you made one bad decision doesn't mean you have to make two. Just because you went to a terrible, boring, stupid party, you don't have to stay. Just because you ordered disgusting food doesn't mean you have to eat it. Just because you said yes doesn't mean you can't change your mind and say no. So that's the one takeaway that you can take from the sunk costs in this class in your everyday life. Other than that, this is money only. Money only. Just because the investment did good in the past doesn't mean it's going to keep doing good in the future. Dump a bunch of money into something that's bad, more money won't make it better. That is definitely true. Though more time might make your relationship better, more money probably won't. So when it comes to money, we do need to cut it off and not be emotional about our money. You be emotional in your relationships, not money. Depreciation. Depreciation is a sunk cost, kind of. Let me explain. When we say cost, we're talking specifically about the money that you pay out to invest in a project or an asset. So when we buy a large expensive asset that goes on the balance sheet, the cost happened in the past, but the depreciation keeps going into the future, right? That doesn't mean we're actually spending more money through the future. We're not. We already spent all the money in the past when we bought the asset. The depreciation, all that does is move the debit from the asset to the expense account. So it's not really spending more money when you have depreciation. It's just reallocating the money you already spent. But there is one thing about this. Depreciation is tax deductible. So when you have depreciation in the future, it's going to make your taxes lower in the future, which does save you money. So we actually like depreciation in the future because it saves us money on our taxes because it's a deduction. So it's a little bit backwards of what you would think. So if the more depreciation we have coming up in a project, it's not the depreciation itself that matters, but it's the money we save on our taxes because of it. So it's the tax benefit from the depreciation that actually matters in the future, but not the money we already spent in the past to buy the asset itself. But we do save money on taxes when we have depreciation in the future. All right, opportunity costs. This is the most convoluted, frustrating part of doing this this chapter in class. And that is because opportunity costs are infinite. The whole point of an opportunity cost is what are you giving up by doing one thing at any moment in time. So we have like a finite amount of time and a finite amount of money. If you had infinite time and infinite money, there would be no opportunity cost. But We have a limited time and limited money. So if we spend our money on this, we can't spend it on that. If I spend my time doing this, I can't spend my time doing that. So you spend your time coming to school, and other than like those of you who are out there making money right now on FanDuel, most of you are not earning money at your job right now. So you're giving up that salary to be here. That's an opportunity cost, and it can be huge. It can be really big because you have to pick what you want to do, and then that makes it so you can't do the other thing. And the reason it can get really big is because of this time value of money. When you have an opportunity cost, you're giving up money now. And money now is worth more than money later. Let me explain. If I have $10 today, I can put it in the stock market. Hopefully the war ends. The stock market goes up, not down. All right, on average. Maybe a savings account or something. I loan it to somebody and they pay me interest. So I loan somebody $10 today. They give me back $11 at the end of the month. So $10 today is worth $11 at the end of the month. So if you say, I'll give you $10 today or $10 at the end of the month, I'm like, oh, today. I take it today because I can make it into $11 by the end of the month. So if I give up something today, you give up your wages today to come to school, it's not just your wages. It's your wages plus all the interest you could have earned on that while you were in school. It's a lot more than it seems. And not only that, but if you get a student loan, you're now paying interest and not earning interest. So it can get you coming and going. And you know why? Because we already took this class a long time ago, and that's how we set it up. Because that's capitalism. Because capitalism, okay, ready for my capitalism diatribe. I can only give myself 3 minutes because otherwise it'll go on all day. It's an MLM. Capitalism is a pyramid scheme. The whole way it works is that when you have capital, it sucks more capital into it. Capital meaning assets or money. It's supposed to work that way, and it funnels up. That's the only way it can work. When you have a brand new land that you can conquer and exploit and murder everyone who already lives here and take over, you get all these natural resources, and that really helps fuel the pyramid. It sucks in the resources from the bottom, pushes them up, and you start growing. But if you run out of resources, just like with an MLM or a pyramid scheme, you know, you're trying to like recruit people, build your downline, you run out of people, then the whole pyramid just collapses and then nobody makes money and the top people run off with all the money. So in capitalism, it works the exact same way because of interest. Interest is rent that we charge each other to use our money. So if you stay in my Airbnb, I charge you rent and then you give me the Airbnb back. I let you use my money, I charge you interest, and then you give me my money back. That's how it works. It's just rent on money like it's rent on anything else. So about 1930, capitalism started tipping over with the stock market crash, right? So federal government instituted income tax. It's the only way to suck the money out of the top and put it back in the bottom. It's the only thing. It's the only way you can do it because the bottom will run out of resources. We ran out of land in about 1930 and natural resources in 1930 in the US. So the federal government said, okay, we don't want the economy to collapse. We don't want the pyramid to tip over, but it's motivating. The money is motivating. So we got to keep capitalism going to motivate people. So we suck it out of the top with taxes and put it back in the bottom. And it's that cycle that perpetuates the economy. So when we have governments that stop the flow of taxes out of the top, then the pyramid starts tipping. And for all his faults, Donald Trump genuinely thought the tariffs would work. He really genuinely did. He thought if we could just close the US system, whoever, I don't know, I don't even know if he has a thought of that's like a real thought, but somebody around him, and maybe a thought he had back in the 70s, because it probably would have worked in the 70s, says if you just close the system off, then the money will just naturally cycle in the US. The problem is you can't close the US off from the rest of the world. So when he did the tariffs, the money just spouted out the top of the pyramid and we made a fountain and it just went over into the other countries. And then no immigration, so the money's not coming back in. So we've got a little bit of a problem. Don't worry. Don't worry. I'm not the only person who thought of this. I'm not the only person who knows this. I'm definitely not the smartest person in the United States or the government or the Federal Reserve. We're all in this together. I'm teaching you so you know, and you can tell other people if there's a situation, so you know where we're at right now and the problem we're currently trying to solve. So in the 1930s, we solved it with taxes. I don't know how we can solve it now necessarily, but it's not my job to think of the whole solution. But I think we can do it all together if we all know what the problem is and think about it collectively, right? So crypto, big problem because it's untraceable. So the taxation stops working. Interest stops working how it has been. Anyways, so that's our definitions for chapter 11. Come back Thursday for some more decision making. And stay safe and have a good day. Don't worry about the economy. We will fix it. I promise. Oh, yeah, sure. And that's chapter 9. Yeah. Okay, let me stop the recording here and then I'll do it.